Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Dr. Weisberger, Managing Director of Institutional Advisory and Solutions at PGIM, Eric Sterner, Chief Investment Officer at Apollon Wealth Management, Rick Pitcairn, Chief Global Strategist and Chairman at Pitcairn, and Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk. We're here to discuss why a sustained positive stock-bond correlation regime could be a new investing environment for many market participants. It is great to have all of you back with us, as always. And Noah, you pointed this out about this stock-bond correlation. What's going on here?
So first of all, thanks for having me. Great to be here with everybody. So stock-bond correlation, in our view, is top of mind, especially our institutional investors and asset allocators. It's a new world. It's a world that we haven't seen for 20 years. And we think it's got good support in the sense that a lot of the big changes that we're seeing. So on the one hand, growth, inflation may be a little bit back more to normal levels, but we think there's some real new macro paradigms hitting the market, and all of which kind of translate to positive stock-bond correlation. I'll just highlight them, and then we can obviously, I'm sure there'll be topics of discussion, but fiscal policy, top of mind, where we are with debt to GDP. We think that has direct impact on helping to support positive stock-bond correlation, and not much prospect for any fiscal consolidation that's needed. Some monetary policy uncertainty in terms of what the reaction function is and how they set policy, and also the interplays between high levels of debt and how monetary policy might be conducted, maybe a little bit less independent than we're used to. We think that also feeds into positive stock-bond correlation. This is reflected in high rate volatility. I mean, rates have been choppy, but volatility in the rates market is high, especially if you contrast that to the equity market, where vols are back on low. So we think there's a lot of uncertainty revolving around rate risk stemming from fiscal and monetary policy. We think that translates directly into positive stock-bond correlation, and that in turn impacts the proper way to construct a portfolio and how to set expectations. So we think this is something that's here to stay, and something that people need to consider. So,
I mean, Eric, it sounds as if you can be bullish in both the equity and fixed income markets.
Yeah, absolutely. I think there's a lot to be optimistic about. Obviously the U.S. S&P 500 has been on a run, and the knock on it has been the narrow breadth. But we're expecting that to broaden out, and the broadening out has come and gone in the fourth quarter. It's kind of gone away, but it's going to come back. Next quarter, or this upcoming quarter, we expect 8 out of 11 sectors to produce positive earnings and to also increase their net profit margins. And there's a possibility we can even see all 11 sectors produce positive earnings, which will be the first time since the first quarter of 2021. So that will just add a lot more sustainability to the markets. And even on the small cap space, they've been struggling because they're more interest rate sensitive, and they've been in 6 straight quarters of negative growth. But we expect small caps to produce positive earnings in the third quarter of this year. And going into the fourth quarter, even 2025, we expect small caps to outgrow large cap earnings. So we could really see a strong small cap rally, and that could be triggered by the first rate cut coming from the Fed.
Right, and Rick, it's interesting because the market does continue to climb this wall of worry that's out there when you think about it from a longer term perspective. Not only do we have an election coming up, but fiscal policy seems to be a concern, and it's not going to go away in terms of spending anytime this year going into an election.
I don't think so. We've in fact, if you look at the history, excuse me, of the last 25 years or so, the market has taken its cues off monetary policy. We've looked at Greenspan, we've looked at these leaders to say, okay, what's it going to do? I really believe that over the next 10 years, fiscal policy is going to take that center stage, because, when I hear, I've been around a long time, I've got some gray hair, when I hear, our debt levels don't matter, valuations don't matter, I start to get a little worried. And I think that's where we are right now. I would agree that it's hard to see long-term our 10-year not reflecting, the fundamentals of our economy that have changed so much in the last 5 years.
And I would just highlight one of the historical, there's sort of data and there are anecdotes. And a historical anecdote, we haven't really, at least to my feel for the market, worried about fiscal policy risk probably since like Volcker and Reagan had their showdown. Predates my market lifetime. I was alive, but not as a market participant. And Reagan and Volcker had a showdown over fiscal policy, and that was part of the big shift then that led to negative correlation and lower interest rates. And we may be back in that world where fiscal policy influences rates directly, and market concerns focus on fiscal policy. I would put that as one of the #1 issues to be thinking about. I agree.
It seems as if it's almost healthier to focus on that versus just what the Fed is doing, because fundamentals do matter at the end of the day, whether you're looking at corporate fundamentals or how the nation itself is balancing its own balance sheet. But Chris, I want to talk about data for a moment here, because on the Market Intelligence Desk, you guys are talking to our Nasdaq listed issuers, our companies. You focus on the consumer space, and from what you've heard from senior management at consumer companies is that the data is catching up to what they see happening.
Right. So when you talk to the issuers, you're looking, and when companies are speaking, you have to listen to them because they're mostly forward-looking, right? They're putting out guidance, looking to where their runs are going to be coming from. And on the consumer side, if you look at the Q4 and Q1 earnings calls, a number of companies, large companies as well, were very cautious of where they're going to be, and it impacted the stock price significantly. Some of them are S&P 500 companies, others are in the mid-cap. And when you listen to them and you look at the data, retail sales were still very positive at the beginning of the year. Inflation hadn't come into where it is right now. The disinflation narrative is starting to play out a little bit. Unemployment really hasn't ticked up that much. And when you look at wage growth, it was still pretty consistent across the board. You could justify that extra spend. So when you're looking at passing price through, especially if you look at the PPI data, people were accepting of that. Now that the data is starting to show that, one, you break the bucket of the consumers into the lower mid class and wealthier, lower income families just aren't there right now. The trade down's not there. The mid class is trading down. For some companies, that does make a difference. And the shift in spend for the upper class is really moving now to travel and leisure and experiences. So that's leaving a lot of the consumer names kind of in a drag right there. So when you look at what they're saying, the data's finally catching up to what they were telling us 3, 4, 5 months ago, and now it's starting to gel. I'm just going to be curious to see what happens coming through. Generally, July is a pretty good month for the markets as a whole, and people do go out and spend in the summer on certain items, but really,
more services
and experiences and travel.
Right.
And when you look at that, it's not going to really change the narrative as much. So I'm cautious when I hear people talking about that, especially when they're offering guidance. And some of the equities that we've seen have been hammered, 30, 40, 50% haircuts from the November, December highs when everyone had, rate cut enthusiasm. We're going to cut 6 times this year. Now we're lucky if we get 1, maybe 2.
Right. Well, you also don't want 6, 7 rate cuts at this point, because that's a big signal that the economy's in trouble. So Noah, we need the labor market to stay strong, and the consumer cannot fall off the cliff if the Fed is going to execute, I guess, a soft landing, whatever you want to call it.
Yeah, a couple, just to follow through on a couple of those points, especially your comment about the services, which is kind of where the stickiness in the inflation market is going to be. And I think that's another source of uncertainty, and it goes hand in hand with fiscal policy, which is where are monetary policymakers in terms of how they react to increment of inflation, increment of unemployment. We know that they've sort of talked about this long-term average inflation targeting. We've never really put it to a test over a long cycle. There have been some economists that talked a little bit about moving up that, at least the idea of a 2% target may be not achievable or maybe not desirable to achieve. And I think the market's going to have a little bit of a hard time digesting or forecasting or predicting where the Fed goes. And I think that plays into very much some of the uncertainty coming from the fiscal policy side. I think these all kind of add up together to see some of the changes in the market that we are seeing. But that's how I would see it reflected, which is how will monetary policy makers react? We don't really quite know yet. Will they cut with inflation where it is today? That would be, if you had an old-fashioned 1990s view of the world, you would never cut with growth where it is and inflation where it is. It wouldn't even occur to you. But this may be a different world. And I think as the market learns that process, it may be a little bit messy.
Right. Yeah. I mean, we don't have a benchmark to this, right? I mean, we spoke about this off camera before. Everyone sitting at this table, we do not remember what it was like 100 years ago with the prior pandemic, so we don't have a path forward as guidance. We think about all the liquidity that was flushed into the system, whether it was through the Fed, through credit, whatever the case may be. Now we're coming out of it, and there's just dynamics that have shifted, or perhaps the dynamics we saw over the past 10 to 15 years. Rick, that was the anomaly, and we're going back to what's considered more normal from an economic perspective.
Well, from a rate perspective, that's probably what's going on. But still, I think you have these long-running impacts of COVID that really surprises us that we're still dealing with them some 4 years later. But we've had a super deep and long inversion of the yield curve, which classically we thought would have caused a recession. Hasn't yet. And to your point, the Fed's probably looking at that and has a proclivity to ease. And I think they have a little latitude because the 2% inflation goal, it's a little like, the 6-foot COVID thing. They really didn't get it from anywhere. It's just sort of, all right, that sounds good, let's do that.
100%,
and which gives them the ability to say, well, maybe it's 2.7 and we can go ahead and cut in this environment, even though we got stocks at records, we got housing at records, we got low unemployment, none of this environment where we would have ever really cut before. We might just do it this fall. I expect we will.
But Eric, it's so concentrated, to Rick's point, it's in housing. It's concentrated in areas of the market, right? I mean, you know exactly what I'm alluding to there. I mean, it can't just be one, a handful of stocks that's moving the entire market. And to your point, you had said, perhaps in 2025, we'll start to see some follow through with the small caps.
Yeah, absolutely, and especially we saw that with the small caps when the market was pricing in 6 to 7 rate cuts back in the fall, and it jumped 25% in less than 2 months. So that's why I always, while investors are looking at the Magnificent Seven or Megatech and ignoring the small caps, which have been beat up because of the higher rates, the regional banking concerns that still exist. Once we get a better indication of when that first rate cut may come, we're going to see, I think, a very strong rally there, because the ratio of the PE of the Russell 2000 to the Russell 1000 is at a 22-year low. So there's a lot of room for multiple expansion within small caps. Large caps, on the other hand, we know they have richer valuations, so earnings are going to have to drive it. So that's why I think it's important for investors. They may have been tempted to concentrate their portfolios to the mega techs over the past 18 months, and who could blame them? But now is the time to really, the diversification is going to pay off, both large caps, small caps, even international going forward.
I would also argue, I'm sorry, Chris, actually, I know a point you're going to get here too. Investors are incredibly discerning. So just because small caps might have a more attractive valuation,
exactly
they're being really picky.
So I mean, if I can get 5%, even 4.5% on a nominal rate, why would I want to put money into a Russell ETF, especially with the bottom tail of that? 40% of them are cash burn anyway right now. And a lot of the debt that they have is really near term. And they pushed it off at the beginning of last year. They did 1-year, 2-year terms, hopefully that the interest rates would come down so they get favorable longer term in order to fund their business. It's more of a pickiness, I think, right now. And if you look at the charts of the 4 major indexes, the S&P 500, the Russell, the Dow, and the Nasdaq 100. The Nasdaq 100 and the Russell and the S&P 500 are so overbought. The RSI has been trading over at 75, 80, especially the Nasdaq 100. And then you have a blip where Nvidia goes down 3 days, and the RSI falls down to a 67, coming out of an overbought territory. Russell hasn't been there, and the Dow, the way it's structured up, the price base isn't there either. They haven't been overbought since back when you had the Q4 euphoria on the Fed pivot. So I find it hard that the Russell companies right now can be such an attractive area unless you're stock picking in the near term, but longer term, it's a great buying opportunity. I mean, don't you think?
And I agree. I think investors shouldn't look to get access to a passive approach, because the economy is slowing down. We know consumer spending is slowing down. All indications are it's going to be a soft landing, but I think investors should really focus more on quality. Look at those companies, whether you're focused on large cap, small cap, whatever sector, companies with strong balance sheets, strong cash flows, because all indications are, soft landing, but it's in a slowing economy, you want to focus and lean into that factor.
And high quality fixed income too.
Absolutely. I think that's why I prefer more investment grade bond options, government treasuries, high yield. Yeah, they're paying attractive yields right now, but if something, if the consumer does fall off the cliff, if the labor markets do fall apart, we could see those spreads really blow out, especially on the high yield side.
But I think your great point, Eric, is that we need to counsel investors to stay diversified. In this environment, they want to narrow down and narrow down and narrow down. Yeah. And I always say, if there isn't anything in your portfolio that you hate at any given moment, then you really aren't diversified. You're just chasing, right? And you have to have that mix, because this environment reminds me really a little bit of the converse of 2009. When I went on shows in 2009 and said I was long equities, everybody looked at me sort of sideways like I was a little crazy. And then 4 years later, it was like, well, duh, yeah, you should have been buying. Yeah, U.S. equity was cheap in 2009. I think when we look back on this environment in 3 or 4 years, I don't know if the comeuppance is in December or a year from now, but this will be seen as a very heady time. It's a super momentum market. Valuations are rich just about any way you cut it. Obviously, there's this major driver of AI out there that could bring us you know, a real revolution in efficiency, but nonetheless, this market it's good. We have long-term investors and they have equity on the playing field and people are making money, but we shouldn't just forget all the lessons of history, I don't think.
Of course, but you know, we always get this question, is it comparable to the dot-com bubble in the late 90s? It's different this time. I know we say it's different, it's not different. We are more dependent on technology than we ever were 20 years ago, and that's what feels different to me.
Yeah, so a couple of thoughts. The first is just on the AI comment, right? So, and this is not to bring everything back to stock bond correlation, but the prospect of a positive stock bond correlation kind of reminds you of the late 90s preceding the tech bubble. So that's where we are. That's not necessarily a bad place. You've seen, if you squint at the numbers, you have seen in the second half of last year an uptick on economy-wide productivity growth. I don't know that I would attribute that to what's driving the equity market, and it's not going gangbusters the way the equity market is, but to me that's a potential silver lining. It's kind of growth that doesn't lead to inflationary pressures. The other potential supply shock would be quite negative, and on the geopolitical risk side, we can talk about that in a moment. But what I think stands out in the current environment that you didn't have then, even when, is to the extent to which the gap in valuation is also kind of noteworthy, right? So stocks are rich, and by some measures, bonds are less rich. And you sort of, if you look at on a yielding basis, right, you have a fairly wide gap in yields, a fairly narrow gap in valuations. So to us, actually, what the sort of the arithmetic would suggest would be you kind of lean against equities here and into bonds, which really rubs some people the wrong way who look at other indicators to say, oh look, you know, correlation is positive, bonds are no longer just a hedge. Well, they are not just a hedge. They actually generate a return, they have a yield, and they're a diversifier in a portfolio when you have a lot of uncertainty. So I think the valuation argument kind of goes hand in hand with the diversification argument.
Bonds and international equities, I see, is what people want the least of right now.
And I think when we do that comparison with the dot-com bust and the concerns about valuations today, there's a major difference between where it was then versus now. I mean, right now we're seeing the megatechs are at 30, 40 PEs. I mean, the Nasdaq 100 was at about 60 PE before the dot-com crash. So the valuations were that much more inflated. We saw a lot of IPOs coming out where companies 2, 3, 4 years existence. Now we're seeing companies come out later stages that have more 10 years. So I think the market, we're not near, sure, there's always the concern of a bubble with valuations, but these megatechs, their earnings have justified their higher valuation. So I'm not concerned yet of a parallel with the dot-com bust, but we certainly want to remember history and not repeat those mistakes.
Yeah, I would say you're right. The data shows that right now there's more front-end loaded on the earnings side. I'd just say the market psychology and the momentum is very similar. Right? That's what I'm more nervous about.
Yeah, I would agree with that. Yeah.
And Chris, to wrap up here, I'm going to give you the final word. What it reminds me of 99, 2000, that era was the IPO activity that we saw in 2021, 2022. Companies growth at all costs where there was no governance, no balance sheets. The retail investor got stuck holding the bag. They have not seen their IPO prices since the day they went public. To me, that felt more 1999-ish than what we see right now.
Right, so the IPO market coming out of COVID was robust, but a lot of that was driven by alternative investments like SPACs, and that definitely drove a lot of revenue and gave opportunity for companies that maybe weren't ready yet to be publicly scrutinized as a public company to backdoor in. Remember, it used to be shell companies. They would buy a shell company and they'd go public through a 1 or 2 cent, OTC or whatever company, and now they have the opportunities for SPACs. So the SPACs brought a lot of companies forward, but a lot of them weren't ready. They don't have an earnings trajectory. They don't have a growth of profitability. A lot of them significant cash burns, but there are a few exceptions. The euphoria there was that we have a lot of money, we're sitting at home, and retail investors got involved as well now. Zero commissions changed a lot of investments, 25, 30% of the daily trading. That's shifted over the last couple of months, and probably 18 to 20 months, all of last year, beginning of 2023. You saw the IPO market kind of fall off a cliff. Quality investors, companies didn't come through, a lot of smaller caps, but that started to pick back up right now. We've got close to 70, almost 80 companies that have gone public so far here this year. Cap of raise of over 18 billion. Quality names there. Not all of them are AI focused, but the ones that have are getting outsized performance. But you're seeing biotech come back in, which is coming back, which is a big risk on in the environment. The IPOs that we saw back in 99, 2000 .com. You put a .com at the end of the pets.com, whatever it was, right? And people,
Stamps.com.
We've
right,
done,
people
we've
would
done
buy
it
it.
with blockchain, right?
We did it
We've
with
done it with
blockchain.
AI. There's
So-
going to be something every 10 years or so that.
Right, so that's the fear that anything with an AI at the back of it may get outsized euphoric, especially now that retail investors aren't as savvy as institutional investors, may make that mistake, again, leaving the retail owner with the bag.
All right, well, we'll leave it on a positive note that at least the market structure and the way that we are perceiving technology is much more advanced than we were 20 years ago. All right, appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me at MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.